Hi, everyone. Good afternoon. And, well, thank you for joining us on this rainy day. I'm Ulanda, and I will be moderating this panel today. Just a brief background about me. I come from a legal background, but I'm not here to catch anybody. I'm not here to enforce anything. Nothing here is going to be taken against anyone, right? And before we start, I'm just going to let our speakers introduce themselves so you get a better handle on what they know.
Thanks, Ulanda. Hi, everyone. My name's Abel. I lead our business here at Bitgo. Been with the firm now for 3.5 years, coming to 4. And for those of you who are not as familiar with Bitgo, we're a full-stack infrastructure provider. We're the biggest in the world for what we do. We've got over 90 billion of assets on our platform, and we do everything across wallets, staking, liquidity, financial services, stablecoins as a service. Effectively, anyone in the business that needs to touch crypto would like to think that we've got a solution and a way to help them.
All right. Hi, everybody. I'm Glenn. I'm with a company called Blockdaemon. Blockdaemon is a blockchain infrastructure company. We work with a lot of the regulated entities. And in a lot of the crypto services that you use, we're actually behind the scenes of many of the partners that are providing the services to you. And hopefully we get a chance to talk about the individual solutions that we offer to them on this panel as well.
Hi everyone. So my name is Perry. I'm the Chief Compliance Officer of ViaBTC. We are established 9 years ago. We are the third biggest BTC mining pool by computation power. And then basically we have our entire blockchain ecosystem, including our brand name CoinX, with our exchange products, our wallets, cold wallets, and other blockchain ecosystem. So feel free to actually visit our booth to talk to our staffs. Thank you.
Hi everyone, I'm Collin. I'm from Trillion Network. I'm part of the founding team. So we're a relatively new company looking to solve cross-border pain points. So one of the core products that we've launched is actually a stablecoin product. So we've launched a US dollar-backed stablecoin as well as a Sing dollar-backed stablecoin. Going forward, we will be looking to create platforms that will allow users to be able to use not only our stablecoins, but also stablecoins of other issuers to be able to make payments in a more regulated and easier way. I think one of the pain points today is making difficulties in making bulk payments using stablecoins and accounting for them on your balance sheet. So that's something that we're looking at doing. Yeah.
Thank you, everyone. So as you can tell, we have a very diverse panel today, and we have some very exciting, interesting, thought-provoking questions everyone wants to know about, which is, how do we prepare for the next Black Swan event, right? Crypto has its fair share of volatility. Everyone knows that. So let's start off with Abel, since he's the one who is like the digital asset custodian for some of the largest institutional players in the market. How does Bitgo actually help their clients prepare for the next, Black Swan event?
Yeah, it's a really thought-provoking question, truly, because as cliche as it sounds, there are a couple of elements to what a Black Swan event could look like. On the one hand, you would argue that exchanges losing $1.5 billion in one incident is a Black Swan event. On the other hand, you could also argue that liquidity events, right, a la what we've seen at the end of 2022, beginning of 2023, also classified as Black Swan events, right? So our role in this is really at the infrastructure level, on the tech side, on the operational side, and on the commercial side as well. So let's start with the tech side, right? Obviously, as a regulated business with regulatory footings around the world, we have a regulatory and fiduciary obligation to our clients to ensure that when their assets are held securely with us, defined as where Bitgo manages the private keys on behalf of our clients, there is that fiduciary responsibility. And because of that responsibility, clients can go to sleep knowing that their funds are securely segregated from Bitgo's, that their funds are in a bankruptcy remote structure with a very high degree of insurance coverage that's provided. So that's the bare minimum, right? And then at the operational level, we always advocate for our clients to take best-in-class measures to prevent any potential hacks, both at the tech level and at the operational level. As you may be aware, a lot of compromises in our business stem from carelessness.
Would you say more of them come from like human actors, or is it like the underlying infrastructure sort of hacks?
A combination of both, right? The human actors help to maneuver against the infrastructure. If you look at a lot of the recent compromises, especially at some of the biggest exchanges around the world, there's always an element of humans being manipulated to take a certain action that allows the tech to then becomes compromised. And that's where we come in, right? To advocate for best-in-class practices to mitigate as much of this as possible.
Yeah, thank you very much. And I know everyone here is also thinking about what about the compliance angle, right? There are also regulatory issues where, for example, suddenly a government is super hostile against crypto. So Perry, our head of compliance at ViaBTC, please share with us the strategies for compliance here.
I'll probably divert from regulation a little bit here because Black Swan event, by the simplest definition, is rare, highly unpredictable, and it represents risk that the existing system cannot contain, cannot predict, cannot manage, so it spills over to the other parts of the financial systems. In terms of the crypto world, in the Web3 world right now, we should look back in the history to actually look for some context. Let's say in 2011, the first hack from Mt. Gox. So basically that is one of the worst first hack in history. Basically, Bitcoin price tanks. But then what's more damaging is actually in 2014, where Mt. Gox was hacked for 840,000 Bitcoins, representing 70% of the Bitcoin transactions around the world at that time. So that is truly a Black Swan event, which is getting hacked. And then the liquidity was basically gone or dirty, let's put it that way. But then for a mining firm, a mining pool like us, or a Web3 firm like us, so there's two sides that we have to protect the customers and protect ourselves. First of all, in a company side is our security practices, our audits. So basically like SOC 2, Type 2 audits that we should be doing to ensure that we're up to standard. And in the user side, in terms of us, we provide several packages that, mining pool, if the users, if the miners are contributing their mining computation power to our pool, they either get a fixed fee for contributing their computation power to us, no matter if the block is mined by us or not, or they can go to the variable side, which is if we've successfully mined the block, then they will share the better commission, better benefits of mining the block and the Bitcoin reward. So different types of payouts, standards to help the miners manage their economic circumstances.
Thank you very much. And now, of course, we have to hear from the stablecoin issuer because, why? The Terra Luna depegging event, I'm sure is still fresh in everybody's minds. No one has gotten over it yet. So, Collin, please do share with us, how do you, as a stablecoin issuer, counter all these Black Swan possibilities?
Yeah, sure. I think first off, the stable coins that we issue is a bit different from, Terra Luna and UST, right? So UST, I think everybody is aware, they are an algo-backed stable coin. The price of pegging it to the dollar is based a lot on arbitrage on the market as well as market sentiments. Whereas for us, we are a fully collateralized stablecoin issuer. So the amount of reserves that we have backing our stablecoins in circulation would always have to be on par, or if not more, than the value in the circulation. And so I think that's the main difference. And I think in the Black Swan event, for stablecoins which are algo-based, which are based on market sentiments, would face a higher impact than stablecoins who are collateralized. But that said, I think for us in a Black Swan event, the thing that we have to be aware of is redemption risk, right? So it's the same, not just for stablecoin issuers, but also for exchanges, OTC desks, trading firms. My background was actually, I was in a trading firm, one of, I would say, APAC's leading crypto brokerage called CoinHako. So during Black Swan events, it's about shoring up liquidity, ensuring that you have the reserve to meet redemption requests. Because what kills a business is actually not long-term liabilities, but short-term liabilities. So for a stablecoin issuer, I'm always conscious of the fact that I must be able to unwind my investments fast enough, my deployment of reserve fast enough to be able to meet redemption requests. And that stems from identifying certain short-term duration securities to invest in. So under Singapore regulations, there is a strict requirement to not invest in securities that are of tenor that's more than 3 months. For us, I think we take that one step further to identify products which allow us to unwind within T+1, or if not T+2, so that in terms of the service level standards that we have to meet our clients on, in the event of a black swan event happening, we can unwind quite easily without taking sort of losses for unwinding long-term securities. And I think that brings us to the point about US banks, right? The recent US bank collapse from Silvergate
yeah.
and all that. I think what killed them was really the fact that they were too heavily invested in long-term securities. They had to take a loss to unwind the long-term securities in order to meet short-term demand. That created a negative P&L on their balance sheet, and that really is what killed the business. So for us as issuers, we must be aware and kind of conscious of the fact that we always have to meet short-term liquidity fast whenever a market event happens. Yeah.
I would like to build on that. What about diversification of banks? Because so I think Circle did have quite a substantive amount of fiat held with the Silvergate Bank when it collapsed. So it wasn't exactly like treasuries, but I guess this has now prompted more like thoughts about diversification of banks. Is that something that you have thought about as well?
Yeah, of course. I think for any prudent business such as us, we have a few banking relationship partners, and we only work with licensed custodians and as well as banks. And all our reserves are actually held onshore in a relatively safe jurisdiction where banking crisis has not really permeated in the financial industry. So we're all our banking reserves are actually held onshore in Singapore. Yeah.
Okay, I think now would be a good time to move on to the next, segment, which is about liquidity management across market cycles. And personally, I mean, most people wouldn't consider this a black swan event, but I consider the launch of the Trump coin a black swan event because it's the black hole of liquidity. It essentially sucked all of the liquidity from Bitcoin, ETH, and all of your major alts right into the Trump coin. So in a single moment, I think a single day, Bitcoin just, I think it plummeted a couple of percentage points, and everyone was seeing a sea of red except the Trump coin. Now, I think Abel, maybe you could share a little bit about how your company is able to address all this sudden liquidity shifts, especially in like one specific coin.
Yeah, it's an interesting question. I guess at the infrastructure level, we need to ensure that in such events where there's a spike in volume, there's a spike in withdrawals, there's a spike in transactions, that we are well equipped to handle the surge in activity. We're actually in a very weird position where we were at the epicenter of what happened because of our relationship with the broader Trump administration. That created a few interesting conversations for us. We also sit on a lot of Bitcoin, and we also work with the people that were behind the launch of the Trump meme coin as well. So that created a very interesting intersection for us. But yeah, on the trading side, where we have a very active and vibrant trading desk, that also meant that at all times we had to be conscious of what our clients' liquidity positions are, as well as our own proprietary liquidity as well. So if you put all those dynamics together, it can be a very complex exercise. And if you think about how you have to mitigate against any of these risks on any given day with the amount of operations that are going on, it can be challenging, and we do our best to stay on top.
Thank you very much. And now, Glenn, who is the blockchain infrastructure expert, maybe you could share a little bit about how like different platforms and protocols manage liquidity across chains or across like how do they deal with this kind of sudden shifts in liquidity? Yeah.
So from our perspective, we're a provider of node infrastructure. So we run more than 200,000 nodes globally. So, just kind of focused on the node infrastructure side of things. So not necessarily like, liquidity from a monetary perspective, but, if there's a sudden, surge in liquidity, that means usually there's a lot of transaction that is pinging the node, and the total transaction that is actually being parsed on the network is being extremely stretched. Especially the Trump meme coin craze happening on Solana. We've been running Solana nodes since the beginning. And, if anybody asks me about, how do you feel about Solana from an infrastructure perspective, I can put it in a very good way, whereby I can say that Solana is a chain where, they want to run the software based on the future hardware. So, if you remember maybe 2 years ago, Solana chain was not very reliable. And now, there's a lot of hardware innovations, and, those things have been resolved. But, during that time of Trump meme coin craze, obviously there were bots that are spamming. There are sophisticated traders that were tipping different validators, trying to prioritize their transactions and stuff. So if you were just a normal retail user using a whatever wallet on your phone and trying to take advantage of these minting, every call, whether it's professional, whether it's sophisticated, whether it's just normies, they're all pinging the same smart contract. So chances are that your phone wallet service provider uses some sort of generic standardized shared RPC infrastructure, then you probably won't be able to even get close to where the smart contract was sitting. Of course, this kind of begs the conversation, where in a public blockchain setting, do the more sophisticated, the richer guys that can tip, that can buy all of the infrastructure, all the latency things, putting the servers right next to the sequencer of Solana, do they always win? I mean, that's like a principal issue. But at the end of the day, you can think of this from, if you want to think of this from a node perspective, node infrastructure perspective, this may be, once in a year opportunity to take advantage of, all of the research that you've done, and you don't want to get a failed response just because your, infrastructure is just, just adapted for a day-to-day average kind of volume that you see on the network. So a lot of the sophisticated traders and companies and institutions, they started to opt in for dedicated infrastructure where they can actually see exactly where the nodes are, and that node is specifically used by only myself, not being used by 10,000 developers that are pinging in from all over the place. So I think this kind of learning was there when the meme coin craze happened. And I think, depending on whether you really do have a business where you have a customer on the other side, you are providing SLAs to these customers, just like your Web 2 services, your online banking, then, these kind of redundant infrastructure going forward will be absolutely necessary.
Thank you very much. That's really very important to know that you can actually operate your own node too. So if you want to bypass all the fees, you can actually do it for the next meme coin that comes up. No, I'm not shilling anything. Okay, let's move on to counterparty risks in decentralized systems. So everyone knows when you're in DeFi, there's always the fear of interacting with anonymous users, with anonymous validators and nodes. So I think, well, Glenn, I know you've just answered the question, but I think this is, again, best directed to you. How do we actually manage counterparty risks, especially since there are some validators that could be malicious actors? Are there any tools that we can use? Anything to just minimize the risk?
So I think maybe I'll split this into two different topics. So, both are DeFi in a grand scheme of things, but there's the protocol native staking component, and then there's the non-protocol native DeFi component. So the DeFi would be your Aves and your Uniswaps and Morphos of the world. And then, protocol staking would be that if you have ETH, then you basically deposit your ETH directly onto the network itself. So, focusing on staking, like this is my view, right? If you want to hold Solana, Ethereum, you want to hold it for longer term, you are automatically invested in the immutability and also the success of the proof of staking mechanism, the smart contract itself as well. Because you can think of it this way: if the smart contract on that chain fails, if it gets hacked, then your ETH will go to zero automatically. There's no argument about this. So people would stake, and you can think of that as, oh, then if that is the case, my counterparty is Ethereum network themselves. But this is actually a pretty mature space, and there's a lot of professional validator operators like us, where you as a company, you can actually ask a lot of questions to your validator operator, your staking service providers, and say, hey, what kind of SLAs can you give us? Do you have insurance on slashing penalties? Do you have white glove services? What kind of data centers or cloud services do you use? Are you SOC 2, Type 2 compliant? Do you have ISO certifications? All of these kind of standard kind of Web 2 questions that you can ask to make sure you always select the right validator. And obviously, like different validators have different secret sauce. So you're always juggling between the APY, like who can actually do better from a performance perspective, without having to kind of risk too much on the security and the slashing side of things. So that's on the staking side. On the DeFi, it gets super hard because now you can think that your counterparty is some anonymous, coder that has built the smart contract that everybody is interacting with. You can't call up the guy and say like, hey, can you give me an SLA on your thing? Or like, what happens if my wallet is drained? And we've seen like $100 million drains on liquidity pools and things like that. So what do you do there? That's a really tough question. I think for now, what you need to do is you just need to do your own research. But there are also services and platforms like what we're offering at Blockdaemon. We just launched what's called the Earn Stack, which is an API and also widget that integrates a lot of different DeFi venues, including the ones that I mentioned, like Aave, Uniswap, and whatnot, Pendle. And then there is a single entry point to actually accessing all of these different DeFi protocols. And the benefit that you get by using this is that you also get the metadata for a lot of these protocols as well. So you can actually do your research. So if you want to put some guardrails for your customers to make sure that they don't interact with pools that are too small, or they don't interact with pools that have no track record, like you have no idea where the team is and there's no ways to trace it, then you as a service provider can like put some certain guardrails there. You would only post the pools and DeFi venues where you find fit, from a risk perspective. So I think you can do your due diligence to make sure that you protect yourself and your customers. But there is really no like easy answer to define like who's the counterparty and what the risk is when it comes to like depositing your assets into like DeFi protocols.
Yeah, so that's more of like so it's curating certain DeFi pools for the user. And the interesting thing is that Bitgo actually recently launched a wallet integration with Wallet Connect. So I guess the next question is for you, Abel. So how does Bitgo actually assist with this kind of curation of DeFi pools for the institutional clients?
Yeah, we don't really assist with the curation of those pools. What we do is we provide the infrastructure to allow our clients to access those pools securely from Bitgo infrastructure, right? And the challenge for us, obviously, is to be adding those chains on a continuous basis at the Wallet Connect level, at the Bitgo level, to ensure that our clients can safely, through these integrations, access those pools. Obviously, DeFi has went through a challenging period over the last couple of years, but I think as regulatory clarity has come out of the US, and that has then cascaded on into the rest of the world, we've seen a lot of demand for DeFi access again. And surprisingly, this time a lot of that demand is not just coming from crypto-native funds. A lot of them are coming from your traditional investors, your family offices that want to access that space securely from infrastructure that they're familiar with some sort of regulatory footing around the world. So that's where we've seen a lot of those in recent times.
Thank you very much. And I think, Collin, I'm drawing from your past life as a lawyer. right? So how do you assist your clients with conducting some like this kind of due diligence on counterparties, especially for the DeFi protocols?
I think the truth of the matter is that on the DeFi space, I mean, just going back to the theme of this topic, right? It's not really ready for institutions at the moment. So when we speak of institutions and the institutional players that we work with, both on the trading side and on the stablecoin side, we're talking about the big hedge funds, the pension funds, sovereign funds. For the DeFi space, because of anonymity, because of the fact that, for example, from a legal perspective, the uncertainty of whether a contract has actually formed, because you need certain ingredients or formalities to actually be there before a contract is formed between two parties, mainly offer acceptance, intention to create legal relations. These things create uncertainty as to whether a contract is had between, say, a protocol and an institution, as well as going further, if something were to happen, the enforcement actions that can be taken place. I would say that, for example, Glenn mentioned earlier, you can work with operators to get access to staking, which is what Blockdaemon does. And that provides like a good kind of stepping stone or some kind of safety net to get into that space. But at the end of the day, nobody is going to say in their contract that they will take liability if a protocol goes down. That would be excluded from the contract. So for the institutional player, I mean, dealing with anonymity is also another issue. There are strict AML and KYC laws which they cannot get away from. And despite, I think, a lot of improvement in infrastructure, DeFi actors, to be able to transact on the DeFi space to solve the problem of AML and KYC. But that is still a lot of work in progress, and adoption is slow. I can give one example of Aave ARC. Aave is one of the more prominent, I think, protocols for lending and borrowing, right? So they've created a platform especially for regulated players to be able to do lending and borrowing on their platform, and it's called Aave ARC. But today, if you go in and look at it, the lending and borrowing volume there is only $50,000. It's half a Bitcoin. So despite having that infrastructure there, somehow or rather, because of the uncertainties in regulation as well as the ability to create legal relations, I think it's still a challenge for institutional money to flow in. Yeah.
It's good that you mentioned regulatory uncertainty, because that's the next point I want to touch on. Well, Perry, how does your company navigate all these different laws all over the world and yet still continue to be operating in such a compliant manner?
Great question. This is not a sexy question at all, so I'll make it quick. Regulatory uncertainty is probably one of the main obstacles to business models. So we have to be jurisdiction specific. So in terms of being specific, you have to actually identify your business resources, your team, your legal resources, and your products. If the products is, let's say, involving alternative coins, I was avoiding that word. So alternative altcoins. So the ICOs. Will regulations allows you to put ICOs that doesn't have much history on the exchange for the investors? Does it meet the investors' protection requirements? Or futures, the leverage, 10 times, 100 times, there's a big spectrum of investor protection there. So if your company has a lot of products that is not supported by a jurisdiction, but then your resources is there, then you probably need to consider moving out or venturing out to another jurisdiction, or in a strategically speaking way, stay unregulated, but it's not recommended in the long run. So basically, for us, we do a lot of research because our capital team, our VC team, does invest a lot into Web3 projects. So this perspective is somewhat developed with my team to eventually to get insights on the projects viability, feasibility, and legality, and basically how it will be successful in the future. Basically, this is probably the main component, in my opinion.
So how do you actually monitor all these different regulatory developments? Because they change in the span of like a month.
So, pardon me, sorry.
How do you monitor all the regulatory developments? Because they change very frequently, sometimes within a month, right?
Well, with you guys, right? With,
Yeah, with
with
Singapore,
the partner
that's right.
law firms that issues newsletters every quarter, every month. Well, also I spoke about being jurisdiction specific. So basically that limits the resources spent on all the jurisdictions like MiCA in Europe, Singapore, when we spoke about it, Hong Kong, or even here locally, Taipei, basically all around the world. So yeah, with the legal resources, the right partners, those will be the great news feed to give us the most updated jurisdictions and viable business models that we can actually expand on, and also economic substances that we can rely on in specific jurisdictions.
So economic substance meaning BVI and Cayman, right, essentially. So I guess that's the added level of jurisdictional knowledge that you need to know about before you even consider moving your businesses elsewhere. And then there will, of course, be certain things like, I guess, once you open a bank account in Cayman or BVI, you may all become a director in Cayman or BVI. There's a potential that your own personal bank accounts could become frozen or put on the red flag list. So that's also something I guess some companies may think about or should consider, right? I think that's all the time I've got for this panel. It's been a really great time. Thank you very much.